Hi, welcome today, Mark and Alexander, and welcome to the Builder podcast. It's a pleasure to have you both here. First of all, how are you today? And you want us to give a short introduction of yourself?
Sure. Alexander, do you want to go first?
Super. Yeah. Well, Michele, thank you. Thank you for having us both on your podcast. We love what you're doing with it. I had a chance to listen to a couple of the your other shows.
Thank you.
Really enjoyed them and excited to do this today. So I'm Alexander Ross. I'm one of the partners, or as Jared Hoffman would say, born at a young age. Born in London because I wanted to be close to my mother. Anyway, one of the partners at Illuminate. I joined Mark, our founder, around 10 years ago, right at the beginning of the Illuminate quest to upgrade the existing infrastructure for financial services. I joined Mark from Bain, where I was in the private equity group at Bain and Company, focusing on financial services assets. I also spent time, probably another separate podcast, in across Africa, including Nigeria, restructuring a bank, and a few other adventures. Before that was an entrepreneur, and before that an engineer in the battery space. I Illuminate, spend time across a number of our themes. I spend quite a lot of time on digital asset infrastructure, which I think we'll come on to later today, and also with a number of our strategic partners, which Mark can talk a little bit more about in terms of our model. And then I moved over to the US, having led a number of our kind of earlier deals in the US, moved over in 2019 to set up our office here in New York, and hired a bunch of people a lot smarter than me, which I'm very excited and proud of.
Which is a good move usually, yeah.
Yeah, you got to get them on your podcast as well, Michele. They'll tell you they've got much more interesting things to say than me. And so we're a team of around 8 now in the US, and that's me.
Thank you very much. What about you, Mark?
Yeah, so again, thank you for having us here. So Mark Beeston, managing partner and founder of Illuminate. I've been in financial markets for over 30 years at this point. Only done 4 things in that time, though, so it won't take too long. I spent the first 13 years of my career at Deutsche Bank, where I joined as a grad and was there as a fixed income derivative trader and manager when Deutsche was really in its sort of trading transformation on the way up. Ended up moving into management roles. I was chief operating officer of their 2 largest derivative trading franchises, Global Rates and Global Credit, which is what gave me my first exposure to what we would now define as the consortia side of fintech. You sit in the board seats of all the companies that are relevant to your franchise that the bank has a seat on. And left Deutsche on a sabbatical exactly 20 years ago, as it happens, a sabbatical from which I never returned. I joined the Exco of an interdealer broker in the credit space called Creditex, and I set up a post-trade processing business for the credit default swap market. Really interesting learning journey. I joined them at the same time that TA Associates invested in them, so that became my first exposure to the financial sponsor side of fintech that we now operate in, and really kind of learned the 2 core lessons that really underpin the Illuminate DNA and the business model that Alexander referred to. The 2 lessons being, firstly, a horrible moment of self-realization, politely put for your podcast. Oh my goodness, was it really this difficult to sell me something I desperately needed when I was that managing director at a bank? To which the answer was and is yes. The thing that actually then made us successful, which was the second learning, was this wasn't about over the horizon West Coast technology. We had fit for purpose technology, but fortunately we had an industry network that we could take it to with warmth and credibility to give it a good chance of becoming adopted. Still felt like pushing water uphill at various points, but we became the market standard. That led to an acquisition by Intercontinental Exchange 4 years later, which was a great exit. And then after that, I did the last thing I did before setting up Illuminate, which is I joined what was then called ICAP, the world's largest interdealer broker, where I ran the global post-trade and information business for them. Did an investment as the very first thing I did for them in a company called Acagiasoft, which the London Stock Exchange acquired in the collateral messaging space a couple of years ago. Did the acquisition of TriOptima, which is one of the core businesses of the business now known as Osttra, and then set up their corporate venture unit within my division, through which we did Duco, which is now a Nordic capital company, Open Gamma, which is an Accel investment, Enzo, which ICAP acquired, before realizing in 2013 that I kept saying something that my colleagues, partners, and friends that have worked with me for 10 years have heard me say many, many times since, which was that we'd hit a moment of generational change in financial markets infrastructure, and I decided to go all in on that, and Illuminate is the answer.
Nice. I would say that we could have an episode with both of you just talking about your experiences, to be honest, but let's try to
we've worked together now for 10 years, and we've pitched many times together.
Yeah, I can understand.
A duo act, and given we're both upstanding British gents, we don't often pay each other compliments, but it's been a hell of a ride. It's been a lot of fun together. So
I'm sure of it, I would say. But coming back to Illuminate, I would say the first thing that comes in my mind is how hard it is, let's say, to set it up from scratch, even coming from your experience, even coming from financial institution, even having that kind of experience and that kind of network, most of all. First of all, how hard it is to set it up. And second, that is a point that you already touched, Mark, how hard it is to sell something, even coming from that background to financial institutions, because that has always been one of the major pain points in this industry.
Yeah, so I think they're two very different questions, right? So I think setting the business up, I think that whole 0 to 1 concept, I strongly believe that there has to be some degree of founder madness to become a founder, right? Rather than taking a paycheck of whatever level from whatever kind of employer. And I don't wake up screaming. But if I did wake up screaming, it would definitely be waking up screaming, thinking about what the original version of our pitch was, because we were out there sort of telling the world, hey, let's just take it for granted that we're going to raise capital, that we're going to build a team, that we're going to have a pipeline that's going to be interesting. And, our industry partnership model is very much based around really working very closely with large financial institutions, many of whom over the years have become our LPs. And it's great as we sit here today, knowing that we've got 11 strategic LPs across our 2 actively deploying funds. It gives us great ability to kind of market test ideas and introduce founders and get that whole warm introduction thing going, which starts to answer the second part of your question, right? But when you have none of that, walking into 100 rooms, 1,000 rooms, and saying, hey, take it for granted that we are going to, we're going to achieve that, you really need to be part of this journey. Is definitely a real challenge. But the whole Illuminate model is 100% built on long-term relationships and trust, right? You see that with the partnership itself. Alexander and our colleagues, we've all worked together for 10 years plus now. But actually, it's those long-term relationships and trust that actually also help you overcome the inertia of getting something started. People that are prepared to back you because of what you've done with them before, right? And we were very, very lucky to get that backing from some of our early corporate partners.
Yeah, and maybe from your side, Alex, you were mentioning that you were coming from private equity kind of background, from Bain, from those kind of financial institutions. What, let's say, pushed you in the first case to actually join Mark and to leave that kind of structured environment to launch something from I wouldn't call it scratch, but at least from a lower level than those kind of institutions. So, and how hard it was the jump, because I always see, you know, people going from very structured environment to very unstructured environment and feeling the kind of difference.
Yeah, and I'll come back to a couple of points on your earlier question as well. But on that question, I'd started something at Bain called Bain Tech, which was effectively bringing together folks, amazingly with the support from the business, to bring together folks who were eager to leave to start their own business and collaborate around certain ideas on the basis that Bain, you know, would benefit in the future if some of those folks succeeded, and sort of very sort of long-term value thinking from them to set that up. And through that, my aspirations were to go and start something myself, and then met Mark, who was a well-known industry figure trying to start something. And I've also always enjoyed investing. I've done a lot of angel investing in my time and started investing in the public markets probably earlier than I should admit. And that was the combination of being able to invest, being able to work on a very early business, and that's what really sort of attracted me, was the intersection of those two things. With just coming back to your earlier points, I think one thing that Mark absolutely nailed was the structure, right? So partnering with tier one institutions, and he says this a number of times, and we continue to say it today, that we were founded on the basis of partnering with the industry to really understand the problems and sort of and help connect those problems in budget to the solutions out there solving those problems. And that stayed true till today, right? So we had the likes of Market and Deutsche Börse Group as some of our first backers. We couldn't have the banks back us because of Volcker, but ultimately we've ended up with 11 strategics still doing the same thing at a much bigger scale of like understanding those pain points, looking for solutions in the market. And why does that model scale so well? It's because of your other question, which is it's very, very difficult to sell into these large financial institutions, but you can do it at scale, right? So we build that warm network. We identify the advocates of adopting new technology and all of the risks that comes with at the Series A, Series B stages. And we, effectively, and my biggest learning over the last 10 years is just that pretty simple equation of like, what are you charging? Somewhere between enterprise fintech, like 100K to a couple of $1 million annually. How much does it cost to sell that, right? And that number is pretty much fixed, because you go out and hire, someone with a great Rolodex to sell into Goldman, ICE, JP, etc. And you can't really change that. It's going to take you 12 months. It's going to cost you 300-ish thousand per year. And so, like being able to accelerate the rate that you can get things adopted, be able to consistently, through all the data that we collect from our various various portfolio companies, like how much it costs to sell, how quickly, and help to make those introductions earlier. You really only have one lever, which is your pricing, and pricing is a function of kind of the depth of your product, really, as to what you can and the value that the product's adding. So all of those things are embedded into our model, right? The honeypot of all these great solutions that makes it slightly easy, and all of our strategic partner relationships that makes it slightly easier to sell into these end buyers. The long-standing partnership and trust that we've built with all of the tier one institutions and that we continue to add to. And amazingly, that has been the same since day one. Like we haven't really changed our strategy. Which so again, kudos to Mark on coming up with that idea.
Yeah, I think the one thing I would just add to come back on that second part of the question, Michele, is because Alexander sort of alluded to it. Like one thing that we quite often say to young companies walking through our door is like, look, we can't help you necessarily reduce your bank sales time from 24 months to 12, right? But we can probably help you start warmly, with a warm introduction to the right person 18 months earlier, right? Alexander and I had lunch with a bank yesterday. It will remain nameless. They were extolling the virtues of a product that they were using that's in our portfolio, and Alexander very politely pointed out. He said, "Yes, I introduced that. I introduced that to the organization 3 years before you started using it." So these are not necessarily rocket ship adoptions, but they are also incredibly high LTV. Once you're inside these organizations, you stick around for a very long time, and again, the multiples reflect that.
Yeah, I strongly agree with this one. I always believe that as soon as a bank really adopt a system, a software, or any kind of innovation out there, they are really sticky to it over time. The real problem, the real first, step in that direction is always the trickiest one because, I think that the average selling time to a bank is between 18 and 24 months or something like that, probably. But also having that kind of 6 months in advantage given by someone like you, it really can make the difference for an early stage startup, And talking about the kind of portfolio portfolio companies that you have, I was looking through your portfolio before the call, and it's very, very clear the kind of concept that you have in mind, being very focused on infrastructure, being very focused on enterprises. But I really wanted to understand from your side, which is your thesis, first of all, and second point, more on the qualitative side, which was your best or favorite deal over time? So something that really stick with you, that really liked you on your experience.
Okay. If I can take the first part of that question and I can give Alexander enough time to think about the second. Again, if the firm was founded around what I believed at the time was a moment for a generational refresh of originally capital markets infrastructure, really kind of driven around a change in the macro operating environment post the financial crisis, where we saw a lot more regulation of financial institutions, a fundamental change in their interest in sort of what we call cost control, capital and compliance, and their needs around that. What really I think excites all of us, more than 10 years later, is that over that decade, we've seen an evolution which has brought other generational changes, any one of which you could actually raise a fund around in its own right, that are equally applicable to this constituency. So firstly, capital markets infrastructure really is broader, enterprise financial markets infrastructure. That's the first one. The second one, which Alexander took a lead role in, was taking us into the institutionalization of digital assets, right? So, not crypto, right? In the early days, but very much like what is the market infrastructure that is required to see wholesale adoption by mature financial institutions in that space. From there, I guess the next one is probably what we've seen around the energy transition and carbon spaces, as again another kind of macro generational change, which again kind of passes down into many sub theses in the taxonomy. Private markets, which and then we can kind of broadly define that is private markets, private credit, but wealth and the wealth transition in that bucket. And then last but not least, we've always had this sleeve of enterprise technology that targets financial institutions. If you go back a decade, that might have been largely driven by concerns around data privacy, as an example, with the cloud adoption and what that meant. Today, obviously, it's massively dominated by AI. Look at that. We made it 15 minutes in without mentioning it.
It's unbelievable.
I said it once. I think I got away with it. So like all of those things are sort of top level. And then there's just so much going on within each of them. And what we're constantly doing is market testing that against the needs of the institutions we work with, both our strategics as well as our broader network. So I'll pause there. We can both turn to Alexander and ask him if he's had a chance to choose his favorite child.
Well, I was going to use that analogy, which is all of our children are beautiful. We have no favorites, of course. I mean, we can talk kind of a little bit about our first investment and how that's evolved. Businesses that we've exited. We've had when our fund's the number one performing fund in Europe for distributions for its vintage 2015 vintage, which we're proud of, and there've been around 7, I believe, exits out of Fund 1 and one soon to be potentially 2 out of Fund 2. Again, we can talk to some of those. Not all of those exits were slam dunking exits, and I think that also helps to differentiate us, which is our ability, having again coming back to the points I was making earlier, having spent time building those relationships with the strategics, understanding kind of a pain point, whether that is deep capital markets collateral management or reg reporting or compliance, or whether that's something slightly more over the horizon in terms of digital asset infra or energy transition, etc. You then go out, we do spend time looking at the market, sharing, bringing some of those companies to our strategics, just watching the signals of how quickly some of them manage to navigate the organization or build momentum. Those all feed into our sort of investment decision, and then we'll zero into 1 or 2 of them. And by the time you've done all of that work, you're pretty confident that there is budget, like this is a problem. And so, if for whatever reason, then the business doesn't manage to execute on it, and there are many good reasons for it. Sometimes it's also team related, and some bumps in the road along that side. We can still find a buyer ultimately because they've spent the money, they've built the product, for the industry. So again, there's lots of different businesses we can talk to. I'm happy to kind of dig into a couple of examples, if you want.
Yeah, I would love to see, which are your favorite ones, or at least with the one that you remember, happily after.
Yeah, okay. Well, I'll talk to 2 themes. One is digital asset infra, obviously a hot topic. I mean, one that really excites me in the AI space is Sam Altman coming out yesterday talking about the extraordinary threat that banks will face, and already do face as a function of AI, and how to protect our infra against that.
In terms of identification of the user, right?
Yeah, so like Reality Defender in the deepfake detection space is a business we invested in recently. I think this is a very exciting time to be investing, because if you think about the tectonic shifts, whether it's digital asset infrastructure and potentially the whole of payments, the whole of market infrastructure being re-platformed, our headline thesis is that a material percentage, not the whole market, ends up on public blockchains, but a material percentage ends up on financial services ends up on public blockchains. I mean, another area I find fascinating is the broader energy transition. Those are a little bit more geographically constrained in terms of, Germany, a lot of solar in the 90s. There's quite a high penetration of renewables across Europe. The US, you've got 5 grids. There's a business in our portfolio called NMAC, in the fastest growing OTC energy trading platform in Europe. And if you think about like what's happened in Europe over the last few years with Russia invading Ukraine, and then the impact that had on the European energy markets and the volatility that came out of that, you've got sort of geopolitical, you've got changes in technology between generation of renewables, potentially even seeing more nuclear or as well,
Even new
Then you've
form
got
of energy with nuclear fusion and the latest reactors that we're seeing right now with Tomahawk and everything else.
exactly, and then at the market structure level, you've got about 50% is exchange traded, 50% is OTC, and suddenly you throw batteries in there, in the wholesale market, and you've had historically structural generators of electricity and power and structural consumers, and all of a sudden you've got someone in the middle that can buy and sell in the wholesale markets. It's a wholesale shift of market structure. So that whole world I find, as an engineer, former engineer, I find absolutely fascinating. Obviously, strategics like Deutsche Börse Group are very active in the energy markets in Europe with EEX and ECC, and they own Nodal in the US, and S&P, obviously huge footprint there, also one of our strategics. So I find that area interesting, the digital asset infrastructure. Again, I'm happy to talk to that in terms of, taking the learnings from our capital markets backgrounds and financial services backgrounds and applying that to a new asset class. What do you need? You need custody, you need execution, you need compliance, you need risk management, you need data, and how we then basically, went through the stack and then made investments in each one of those buckets. So Copper, Curve, which we sold to PayPal, also in the custody space, Talos in the OEMS, order and execution management, Nota Bene, which I think is another very exciting business in the compliance. I think they have an opportunity to be the sort of next Swift layer on top of public blockchains, so sort of privacy preserving, et cetera, et cetera. And maybe, hopefully I've given Mark a few minutes to think about his favorite or how he wants to, yeah.
Yeah, I mean, I think one of the things is that our kind of approach is, we look for venture skew, but it's not about, it's not all about rock stars, right? In our world, coming from a TradFi trading background, I always say you can have you can really care about the power law, but it doesn't mean you have to completely disregard, the whole kind of concept of risk reward. And so we're trying to kind of manage that the whole way along. And if we look at, the way that we've kind of gotten to where we've got today, we've never rung the bell, right? That's important to recognize, and it sounds like a very 2025 thing, or 20, even 23, 24, 25 thing to say, but we've been saying it since we set the business up. We may never ring the bell. Right? There are so many trade buyers in our space, and actually add to that now, obviously, financial sponsor buyers, and interest in roll-ups, right? And so our portfolio is kind of become a who's who of next generation. Of next generation businesses. So, we sold businesses to Bloomberg, Fitch, S&P, Trading Technologies, Tunes, Informatica, PayPal, and so they go on to become that that next generation of market structure that we've kind of set out to to fund.
This is actually a very good point, because so one of the main topics that we had in the fintech market in the last, I would say, couple of years was the absence of liquidity events. So not many companies were going public, not many IPOs. We were expecting a wave of M&A in 2023 that never happened. We were expecting the same in 2024, never happened again. We are now in a year where we were expecting a lot of IPO, Klarna, Stripe, all the others. So we are expecting, from a financial institution perspective, a lot of liquidity events this year and other moving forward, but we are still struggling to see them. I think that you kind of tackled down this problem, having smaller M&A approach over the years, in order to have that kind of returns for the fund, for your investors, but also for the companies themselves. So do you actually see these as a problem? Is a problem that you actually add over time? And do you see as a potential threat over time, or are you okay with not ringing the bell even for a long period of time?
And our job isn't to ring the bell, right? Like our job is to find great companies, help them grow, and deliver distributions back to our LPs, right? And I strongly believe that in our industry, like, part of that GP LP contract is actually pretty broken right now, right? Like people are just accepting, it's okay to be a, 2015 vintage venture fund with like 95% of your companies still in the portfolio, the ones that haven't gone out of business, right? Like, I don't think that's okay. And so as I say, our model has always been, to look for liquidity, look for liquidity where we can find it, but actually, like go after situations where you're not just restricted to the IPO window being open. So like actually bizarrely for us right now, it actually becomes a bit of a differentiating factor. We just added to the Fund One DPI a couple of months ago. We've got 2 companies under signed term sheet right now for exits, which should add to the DPI for Fund One and Fund Two. Touch wood. They're not fund returning events. But they're useful multiples on capital that add to that add to meaningful distributions for your LPs, which is what the actual game is about.
Yeah, just to briefly add to that, I think Mark's had me say this a number of times, so forgive the repetition, but the market we sit in is extraordinarily acquisitive. If you look at just the top 10 acquirers over a 3-year period, I think ending 2023, they acquired 200 companies in just the top 10 in 3 years. That's pretty much per top 10. So think, the rating agencies, the exchanges, those types of folks in this space. That's roughly one every 2 months. So it's a busy role in the corp dev seat at one of those businesses. And that's just the top 10. Obviously, there's a much, much longer tail. And when we, early on in the life of Illuminate, it was largely strategics. But one of the things we're seeing more and more now is that, and I think another bank that we sat down with yesterday said that the private equity folks are getting really smart on capital markets. Part of that is driven by a large recent transaction by KKR and a company called Osttra. And some of the trickle down from that, but it's been going on for longer than that as well. So now this sort of, as Mark kind of alluded to earlier, you're seeing these sort of additional routes to exit. And one example of just how acquisitive these businesses are. So Market, who originally were one of our anchor investors in Fund One, by the time they merged with IHS, they had acquired about 80 or 90 companies. On the other side, IHS had also acquired about 80 or 90 companies. And so combined 180, and they then merge into S&P Global, who also on their side had acquired a huge number of businesses as well. So ultimately, these platforms, which are getting bigger and bigger, if you look at the London Stock Exchange and all the businesses they've acquired recently, ICE acquiring Black Knight for 14 billion, each of these massive aggregator platforms are getting bigger and bigger. And one of the key levers of their growth is through M&A. So it's sort of engineered into the whole industry that in order to build new, you go out, you solve a problem, a point solution or a platform, and then you sell to one of the big aggregators who can then distribute at a much lower cost to the broader industry. That's why the liquidity issue is less of a problem for us.
Just to double down on this. Yeah, go on, Mark.
Sorry, no, I was going to say, I think that journey is super illustrative and just demonstrates, there's almost no limit on the size of a trade sale in this space, right? One of the things that we talk about, a lot when we're, out on the road fundraising is, this is a sector that spends more on technology than any other sector than the technology sector, right? $600 billion a year. And that is then reflected in the size of the opportunity, and the size of the companies that are operating in this space. But, we're very pleased that, S&P as it is today have been anchor investors in all four of our funds. But the evolution of that was market, IHS Market, S&P. And if you think about the size of those investors as reflective of what the opportunity is, that was a sub $5 billion, sub $6 billion company when they first came in as market. When they merged with IHS Market, 13. When they get acquired by S&P, that was 33, and S&P today is over 150, right? It's enormous, and that creates a lot of space, in the middle ground for roll ups and for exits as part of that. So, which comes back to your original question, it doesn't worry us at all. Long may it actually continue. If the IPO window stays closed, we will just get to continue to differentiate ourselves on distributions. And I think LPs seem to really care about that right now.
Yeah, I would say so. But doubling down on what you just said, so you were mentioning not only New York Stock Exchange but also London as up, and one of the main financial stock exchange out there. But recently, one of the main topic on critics about this kind of relationship is the lack of new listing on the London Stock Exchange, or at least the decline of London as financial hub, as financial place, in terms of public listing. So I wanted to understand if you kind of feel that kind of difference, also comparing, for example, the early 2000 with the present situation, and most importantly, if you still see Europe as a potential play to invest on and as a land of interest for your side, because we need to face the reality that the US has a much bigger and much better risk capital market than Europe for sure, but also I would say also about the rest of the world. So did you see that kind of difference, and potentially also what we could do to solve it?
Yeah. Well, again, I think there are two very different things in there, right? So the first one is what's going on in increased amounts of companies choosing to stay private, or for whatever reason, and also obviously increasing numbers of companies being taken private, which isn't just a London phenomenon. And then obviously there's the politics of London, which again I think is a separate podcast in its own own right. I do think that the important thing to recognize is that we're London headquartered, right? But from day one, when there was only one member of Illuminate, I was 50% in London, 50% in New York, and one of the reasons for that is that financial markets are global markets, right? If you look at our firm today, we're over 20 people, partner led out of London, New York, and Singapore, so that we can cover all the main hubs, right? When we talked about Market being one of our investors, that was London headquartered business, but when they IPO'd in New York, right? So that phenomenon's been going on. That phenomenon's been going on for a long time, right? We go where the best deals are, and so it's really important to us from a deal sourcing perspective to kind of cover the major financial market sectors. We very strongly believe that, solutions in our space come from where the domain knowledge sits, rather than, where the technology, where cutting edge technology is being developed, because solutions in our space are an application of technology against domain knowledge, right? So, we don't have geographic targets. We will go after the best deals. We've just done a cluster of Paris-based deals recently. I don't think that's because of structural London versus Europe. I think it's because that's where we found some exceptional founders that are doing some really interesting things in the AI space and the institutional digital asset infrastructure space. But the next cluster could easily be another bunch of New York companies or a bunch of London ones.
Yeah, I'm gonna give a similar answer in terms of the context of Illuminate and how we're set up, which is I talk about it as like the watering holes. If you go on Safari, the watering holes of enterprise fintech are New York and London. That's where people come to sell their goods, and in the US that typically means sort of Eastern Seaboard. Coming into New York, but there's a little bit of kind of West Coast tech as well. And so, we're set up in order to serve both sides, and generally the first check that we write at the Series A or late seed stages is in order to fund the businesses to be able to open up either New York or London, depending on where they started. So I think we do have a pretty good perspective on the two sides and the strengths of both. Interestingly, David Solomon, CEO of Goldman, came out yesterday with fairly scathing comments on the London's position, leading position as a capital markets hub, and the impact some of the recent rule changes have had on that. And I do think that's real. I think it's painful. There's a sort of self-flagellating British mentality of pointing out all the things that aren't working well or that are wrong. But I think London is still a phenomenal hotbed of innovation in financial services. Look at the businesses like the Revolut, through to many success stories on the enterprise fintech side that lots of your listeners won't have heard of. So wouldn't write it off anytime soon. And again, massive oversimplification, but I think about like the US is huge, right? West Coast, lots of tech. East Coast, lots of finance. Not necessarily that much fusion, or as much as say in London, where you don't have the markets at the same scale, but you do have those two things in the same place. And some phenomenal AI capabilities and universities around London as well, that sort of help to bring this very innovative sort of hub together. And then just in terms of capital markets, so listings, et cetera, I rightly or wrongly single out stamp duty in the UK as one of the big problems, and I think could massively solve this. I was looking at the numbers recently. I think they only collect in the UK $4 billion on stamp duty for equity trading. And what that really does is, like, every time you trade an equity, you're paying sort of 50 cents or whatever, 50 pence for that trade to stamp duty. And that absolutely obliterates liquidity versus in the US. And more liquidity drives more, better prices. And so there is a depth of capital markets in the UK. But if you with that stamp duty, it's almost a no-brainer to go and list in the US. So, I mean, just a thought. I'd be interested to see what your listeners think and if they agree with that assessment. But that's a topic we should probably dig into at some point.
Yeah, I totally agree. Maybe last question from my side, also given our time constraints. I would love to ask for both of you to talk about which are the main trends that you're following on at this present moment in time in fintech, and the kind of trends that you expect to be, let's say, winning the race in the upcoming, let's say, 2 to 3 years. We have been talking about AI, of course. There's a lot of talks about stablecoin in payments and in cross borders, but I would love for you to say, okay, this is where I would bet my money on to be the next winning horse in this race.
Really good question. Do you want to go first, Alexander, or do you want me to?
Up to you.
Well, I think Michele, you already gave the obvious answer. And I think if you hadn't, I might have said AI, and Alexander might have said stablecoin. So I'm going to try and pick something else, right?
This is why I excluded them in the first place.
Oh, okay, that's what you did. Okay, you outplayed us. Brilliant. I'd go back to something that we said earlier, right? I think that there's about to be a massive trend of roll-ups of, an earlier wave of capital markets fintechs, the likes of which we haven't seen for a long time, right? I think there's an awful lot of businesses that have got themselves into this, 10 million, 20 million, how do we get from 10 to 20 to, to 50 to 100? And so many financial sponsors circling the space now. So I think we're just going to see a huge amount of activity and some transformative deal making coming out in that space. And I'm really interested to see who those next 150, 200 million players are in 5 years' time, because I don't think it's going to take a long time to get there between the combination of organic and inorganic. So that's a space that I'm watching with great interest and relish. I think we've got a role to play in both sides of that.
Very interesting.
From my side, I think it's a very exciting time to be investing at the early stages. So Series A, late seed, and Series B. Never before. I mean, if you look at the graphs of how quickly companies get to 100 million in ARR, it consistently compresses over time. And
we just had Lovable reaching that in 8 months, so it's unbelievable.
It is unbelievable, and so you can create with not very many people an extraordinary amount of value with these new tech tools, whether it's AI solutions and coding solutions, which we were talking about to another bank even as recently as yesterday, and putting those in the hands of business analysts, and how quickly they can then move and cut costs out of companies. So I think that it's an extremely exciting time to be investing at the early stages. I'm all in on venture by virtue of the fact that I'm sat here and where we're investing. I think that it's a combination of a number of these tectonic shifts, the replatforming to digital asset rails, which is taking time, but I feel like it's accelerating. The AI tools and bringing them into the heavily regulated environments of banks. Not letting them completely take control. The wealth management, the great wealth transition of trillions of dollars being handed over to the next generation, and a digitally native generation that has a very different expectations to the previous generation. I mean, it's just everywhere you look in our market, there are these huge, continents shifting. And we're just looking for those like white space gaps to fill.
Cool. Thank you very much. Very, very interesting. Also very interesting that none of you mentioned payments or digital banking, and I really love it. So guys, again, it was a pleasure having this conversation with you. I'm really looking forward to see the next deals that you're going to make, following them closely. And thanks again for being part of this.
Thank you.
Thank you very much for having us.
Thank you.
Pleasure.
Thank you. Bye-bye.